Okay, good evening. This is Brian Stoll for Timing Strategies, Thursday, December the 6th. Well, we got the bar, or the day that we were looking for yesterday today. Good thing we maintained our long position, and we did have the discipline anyway to do so regardless. We were, and if you refer to our previous videos, long 100% from that date as of November the 20th. We took off 65% of that long position in the indices on that day, November the 30th. And today we took the last 35% off today. So we are now 100% flat in the indices. We are still short U.S. government bonds using the RIDEX inverse government bond fund, and we're also long the U.S. dollar, anywhere between 10 to 20% for both of those positions. But as far as indices, like I mentioned, we are flat, 100% cash in that. We are out now looking to initiate a potential short position. Reason why I say that, because again, I am looking for a volatility cycle high sometime coming in today or as late as Monday, Tuesday next week. Obviously, we got the Fed meeting, so that could throw a wrench into things, but the reason, among others, that I am looking to be short is, number one, we have this nice, fat, attractive gap underneath us from Tuesday, and from last week, we also have a nice, fat gap underneath us there. I am extremely confident that that gap will be closed. Just a matter, the difficulty is the seasonality in Christmas and the intervention by the Fed in today's market, if you saw and heard about the bailout and so forth. So for what that's worth. Where we'll look to initiate the short position depends on price action tomorrow. This is the date right here, October 30th, and the price action or the price bar of where the last Fed meeting was at. I'm seeing the type of environment that we saw back in 2001, 2002, where the Fed kept cutting interest rates, and you get these pops, and then it would drop. This is the first time that we're above, and if you look on this line right here, this is the second day that we actually closed above the first Fed meeting back in September 18th. So that is a positive sign to the upside. If the market closes back above our regression channel and above the highs of basically October 30th right there, then I'm going to have to rethink it for the time being. But again, that will be, again, the element of how much we want to add or how much we want to initiate a short position on going into this, the next 3 days. I got a question on gold from someone in an email, so I'd like to just comment on that real quick. Reason why I'm short gold, or not short gold, but reason why I'm not long gold at this point and why I'm short bonds and long the dollar is, the Fed is very active in stock and bond markets for a lot of different reasons. I am long-term bullish on gold. Problem is we're coming into a range. We're contracting on the GLD, using that as a proxy for the real stuff, the metal. And that contraction can stay contracting or contract even further into the end of the year. What would get me long gold? Well, on the GLD, it would get me long on a close above the 81 level or the 82 point. What would really make me more interested in gold is if the bonds came down, interest rates went up, the dollar went up, and we got a sell-off of gold back down to this level somewhere, from the August 16th low. That would set up a much more higher probability point for me to start initiating a position. I'm also bullish on oil. If you take a look at the XLE, before I go to the XLE, let me give you another reason why I'm not so bullish on gold right now, or why I'm hesitant. You look at the GDX. The paper gold stocks generally lead the metal itself 80% of the time. Now there's no certainties, but about 80%, a little better than 80% of the time, the paper leads the metal. The paper is not giving me a confidence to be long the paper stocks, the XAU or the RIDEX gold funds. And it's also just, if you look at the XAU, I'll just pull that up real quick. XAU. Hopefully we don't have a lot of junk on there. Well, forget it. Let me just, just chart objects, delete all. Okay, the XAU, again, is not giving me a lot of confidence based on the price action and the dollar and the interest rates. So with that, I am hesitant. I'm looking for a better entry point. If I have to pay up and the GLD or the GDX get a price close above that 81, 82 level, then I might reconsider it, but then again the position will be smaller. If you take a look at the XLE, no, not the XLE, the XLF, that's looking to be a very attractive short setup coming in here. Where would we get short? Somewhere right around, again, depending on price action, right around that 32.5, or possibly, starting today. Again, the XLE and the financials that are caught, XLF, the financials, the banking stocks, they're not fixed. This bailout thing, it's just a temporary shot in the arm that's just going to wear off probably sooner, probably already starting to wear off. The other position we're looking to get short on for some of the ETF accounts that we manage is the real estate fund. That's not it. Come on. Is that it? That is it. That's just today's bar. Refresh. Maximum. Alright, there we go. The IYR, we're looking to get short in this too as well. Where would I like to get short ultimately? If you believe in fibs, we might be coming into that point right now. So, we're going to wait and see another day or two. And how we would get short the IYR is if we were to take a smaller position, half position, because this is a 2 beta fund, in the SRS, which is a negatively correlated 2 beta ETF. Really neat little ETF. And the other position that we would take a short position for, the XLF, would be in the negative 2 beta SKF. And then another real hot little fund, a little ETF that works real well. So other than that, the seasonality effect things are really a positive, so that's why we hesitated getting short today, but we are looking to do that on most of the symbols, on most of the indices, and using the SPY as a proxy. One thing I want to comment out here is that if you look at the move that we had from November the 6th, it was about a 7.5% move down. It took about 14 days from November the 6th until November the 26th. Took 14 days to drop 7.5%. Alright, as of today, it's only taken 7 days to get back up to that 7.5%. That, if you use cycle terminology, Walter Brezert, the king of most cycle analogies, that's what you might call left translation, meaning we've got a long down and so far short up. What you want for a bull market is you want right translation. You want short down, long up. So that remains to be seen if that's how it's going to start to turn out. Again, I am short-term neutral, but looking to get bearish at the first opportunity that presents itself properly. The other thing that for all the idiot wave fans out there, and I'm one of the idiots, that's for sure. We got a real neat ABC or 2-leg from the pop-up on the lows. Yeah, I know that's from the gap. It's not from the ultimate lows, but that's a little trick if you want to keep an eye on it. It works pretty well. And everything else looking at also has major gaps underneath it. No need to go into that. Too much detail. The Qs, those gaps are going to get filled. I know that. It's just a matter of from where. The diamonds for the Dow, those gaps, they're going to get filled. Same thing with the Russell and the ETFs, all there. So when we initiate the position, and to what extent, if we have to scale in or we can put the position on all at once, is going to be something we'll keep you updated on. Until then, hey, Merry Christmas, Happy Hanukkah to everybody, and till tomorrow.